In this session, we are going to talk about the default probability and the recovery rates, two major aspects which are defining the counterparty risk. So, wherein the first thing I would like to focus is the correct or the different kinds of definitions that are associated with default probability. So, how do I understand them? And then we'll talk about the real world default probability versus the risk neutral, right? Which one we would be using in what case, and what is the key difference that is existing between these two types of definitions of probability. Then we are talking about estimation of the real world default probability, where we will talk about estimating it from historical data, how we can go ahead estimating from the historical data, and then we'll use equity based approach like Merton model to assess or to come out with an estimate of the real world default probability. And then we will talk about estimation of the risk neutral default probability. So what is the mechanism that is available for us to estimate the risk neutral default probability? And obviously I want to do a comparison between the two, which one would be more, which one would be less, by what extent. Such kind of comparison is going to be done. And finally we would bring in the concept of recovery rates, right? How do I link them? What are the important aspects of recovery rates? How do I link them with the default probabilities? So these are the major contents that I'm going to take up as a part of this particular session. So let's get started on that count. So the first thing, the coming out with the definition of the default probability. Now here I will be looking at cumulative probability of default, where we would be representing it by a term like f of t, capital F of t, which talks about the probability of default at any time from now up to a time t. So from any time from now up to time t, if I really want to find out the probability that a particular default is going to occur, it is what we are calling as cumulative probability. So when I am trying to plot the graph for it, it should start from 0 and it should go up to 100%, because at some point of time t, there should be a default. So the probability of default should be 100% at that particular point in time. So that is how we define the cumulative probability of default. On the other side, we talk about the marginal default probability, which is typically the probability of default that is between two dates, not from now up to time t. We are talking about between two dates. So it is like if I am saying between t1 and t2. So I will be writing it as q t1 comma t2, which is nothing but, so between t1 and t2, if I want the probability of default, we are talking about f of t2 minus f of t1, which is nothing but the probability of default from now up to time t2 minus the probability of default from time now up to time t1. So the difference between these two cumulative probabilities is going to give me the marginal probability of default, which is the possibility of default between time t1 and t2. And in this case, if t2 is greater than t1 I should see that f of t2 also should be at least greater than or equal to f of t1. It cannot be less than, which means this difference should always be non-negative, right? It can't be a negative value at all. At the worst case, it can be 0, but it cannot be negative, which means the cumulative probability cannot be a decreasing function. It has to be monotonically an increasing function itself, right? Because I really don't want my marginal default probabilities to be negative. So that is the content of probability of default, the definition. So will be using two definitions. One is the cumulative, the other one being the marginal. Then looking at slightly the other side, we are using two different kinds of default probabilities. One we call it as real world or real default probability, and on the other side we are talking about risk neutral default probability. Now what is the difference between these two? Now real world is purely coming out from historical data. Any parameter which we talk about in the real world, we are talking of historical. Whereas when we are talking about risk neutral, we are trying to imply it from the market prices. Because the same concept of real world volatility and risk neutral volatility we talk about, where we use historical volatility and implied volatility as the representatives of both of them. So in the risk neutral or implied volatility, if you remember, we derive it from the option prices. The same thing. So when we are talking about the real world volatility, we were using historical data. But when we were talking about risk neutral volatility, we were trying to derive it from option prices. So the real world parameters are always a reflection of true values of some financial underlying asset. Whereas when I talk about the risk neutral, we are trying to derive them from market prices. Right? We are trying to calibrate the data, fixing it to the market prices. So that's where I really need to understand the distinction between the two. Right? And generally, when it comes to default probability, so we will be using the real world for the estimation of default probability if I am using from a risk management perspective. If I have to really use the default probability from a risk management perspective, I prefer using the real world. But if I really want to look at the market price of the default risk, so if I want to do it as a price, as a part of the pricing of the product, I better prefer the risk neutral, because I am not interested in the actual probabilities there, because we want something more for that. A simple example I want to bring it here. Let's talk about two outcomes. Right? Let's talk about two outcomes here, just to understand the difference. One, we are saying you gain 100, and let's say that is 99% chance that you will gain 100, and you will gain 0 if for the remaining 1% chance. So the expected value here is 99. Right? 99% 100 plus 1% 0. So the expected value of it is 0. So 99. Now I can very well say this is equivalent to a 0 recovery, 0 coupon bond, where the interest rate is 0. Can I say that? Because that means the price of the bond here is also 99. This is more assured. This has a lot of volatility. but both are priced 99. But any investor would prefer this one, but they would not prefer this because there is a 1% chance that they will lose entirely. So no rational investor would enter into this kind of a bet. Right? I could, because I can lose the whole money. So which means there is a lot of volatility here. And that is what will bring me to the concept that the rational investors are generally risk averse. So if they really have to accept the risk, there should be expected positive return. Only when there is an expected return which is higher, only then they are ready to accept an additional risk. So there should be some kind of a compensation for the additional risk that they are taking because of the possibility of a default, which means corresponding to the historical default rate, right, the actual probability of default, we are also adding some level of default risk premium. So it should be available to me probably for 2 more percent lesser. If it is available for 99, I must still choose this one. But let's say if it is available for 97, I might be willing to purchase this one because that remaining 2%, I will look at it as a compensation for the default risk that I am taking. And along with that, there could be some kind of a problem with respect to the liquidity of that security also. So which means I can even talk about liquidity risk premium as well. Which means, oh, because this can't be sold whenever I want for the price which I want, probably I am taking that additional risk, so I think that it should be sold to me at 94. Another 3% I want to discount for liquidity. So which means actually I am getting a discount of 6%. And logically put, this 6% is associated for the kind of default that I am going to get on this particular security. So that's the reason we say that this 6% is coming out because the price of this is 94 in the market. We are, if I say that, okay, 94 is equal to 100 times. So if there is no default, I'll get my 100. If there is a default, I'll get 0. So probability of default times 0. 1 minus probability of default times 100. So what is that it's coming out? 94 is nothing but 100 minus 100 PD. So it's working out 100 times probability of default is 6 and probability of default is coming out to 6%. So if I am trying to find the probability of default by calibrating with respect to the market price, that is what I am getting as a risk neutral default probability. So which is coming out as 6% here, whereas the actual probability of default, which is the actual of the bond defaulting, is close to 1%. Now that is where the difference between these two exists. So some important points to note in this context is, in reality what we see is the return that we are expecting on the corporate bonds, it is more than adequate to cover the default losses that are expected to occur on those particular bonds. So in quite a big number of real world scenarios, what we see is risk neutral default probabilities are always greater than the real world default probabilities. This is one example also I have shown you, so you can very well relate to the reality. So a few points. Real world are generally the actual assessment of the probability of the counterparty defaulting. So for any kind of quantitative assessment, right, for any kind of quantitative assessment, we are still relying heavily on the real world default probability itself. Whereas risk neutral is more associated with the market prices. So they are very useful for pricing and hedging of the risk. So if we are using it for pricing purpose or hedging purpose, better use the risk neutral probability of default, whereas if our objective is risk management or any quantitative modeling, then it's better to rely on the real world default probability itself. Alright, now let's move on to the next one, where we are estimating the real world default probabilities. So we'll talk about two approaches. So the first one I would like to look at is, how do I get the real world probabilities from the historical data? So this is purely by using the past experience of default, which will be helping us to predict the future. I would be using the past default data and the past default experience and the historical data to predict the probability of default for the future. So one of the major tools, we use a kind of transition matrix. So it's a kind of a matrix that is developed based on many years of data. So it's as good as it would be like this. We have credit ratings, let's say AAA, AA, A, triple B, some such kind of ratings would be there saying this is the current rating. And here also you will have, okay, the rating at the end of the year, AAA, AA, A, right, and probably a double B, triple B, and finally default. Now within 1 year, this is always a 1 year transition matrix. Within 1 year, what is the chance that a AAA rated company now will still remain at AAA? This is one number. The company which is rated AAA will move to AA at the end of the year. Similarly, will go to default at the end of the year. This is the kind of a matrix that would be developed, right? Which is generally created based on the actual data, the actual experience of default, based on so many years of data, which is actually published by an organization called Tenet. So it gives me the historical probability of moving from one rating to the other during a 1 year period. And towards the end, these numbers talk about what is the probability that a AAA rated company will default in 1 year. What is the probability that a AA rated company will default in 1 year? What is the probability that a triple C rated company will default in the 1 year? So that is what is represented as a part of the table. So there is a probability of default that is coming, and it also mentions how the defaults are going to occur, the structure in which the defaults can typically occur. And I can very well try computing. So this is the 1 year. So for this 1 year, I can think of doing the matrix multiplication and arrive at cumulative default probabilities, the capital F. I can very well compute for each of the credit ratings. And while doing it, it's nothing but a matrix multiplication. And while doing it, all we are making as an assumption is the matrix is constant through time. That's the reason if it is for 1 year or 2 years or 5 years, we are taking that matrix to be constant through the time. It's a very elementary assumption, because in reality, the default, the probability of default, or even transition from one state to another, they change throughout the economic cycle. But yeah, if we are doing it over a longer time periods, okay, in one period things are up, in other period the default and transition probabilities are lower. So overall for a longer period things are going to adjust up. So we are doing a multiplication. If I want an n year matrix, means at the end of n years, what is the chance that it goes from one to other, or if it goes to default, then you just multiply this matrix n minus 1 time. You multiply this matrix n minus 1 time, that will give you the required computation of going from one state to the other. Now here, historically there are some interesting observations that have come out. The firms that are having good credit ratings, AAA rated, AA rated, right now they have a good credit rating, so they default less compared to the firms which are having a worse credit ratings. That is something that is known. But one interesting part is all those bonds that are having investment grade ratings, which are the very high AAA, AA kind of ratings, anything above triple B, right? So whichever are the ones are having this kind of ratings, the default probabilities, they are tending to increase with the time. So today the default probability could be lesser, but as the time period is increasing, the default probability is increasing, which means today it may be a good credit rating, but there is a good chance that its position may become poorer in the future, and the probability of default might go up in the future. Similarly, when we are talking about non-investment grade ratings, where the bonds are already under the high yield category or junk category today, which have a poor credit rating today, which is less than double B or so, we are expecting that the probability of default is going to go lesser with respect to time, because if at all they default, they have to default now itself. Their situation is much bad. But if they had survived for the first few years now, by this time their credit rating would have improved considerably, and their chances of defaulting after a longer period of time is considerably going down. So that's one more observation that has been found from the real data. So for AAA kind of a rated companies, we are seeing that the default probability increases with time, whereas for non-investment grade ratings, we see that the probabilities of default are going to decrease with time. And what has also been observed is the mean reversion is one more characteristic that has been observed with respect to the credit ratings. So the companies which had an above average credit rating, they tend to deteriorate, and if they had a below average credit ratings, they tend to improve. So that's one more dimension that has been looked at. So while we are computing the credit value adjustment, the pricing of the counterparty risk, so we are looking at one, the cumulative probability of default, but along with that, I am also looking at year over year marginal distribution of the probability also is what I am looking at. Because for some kind of securities, for some kind of ratings, it is first increasing and then decreasing, whereas for the other set, it is first decreasing and then decreasing. Right? Because if you look at a typical AA, AAA, A rated kind of company, if at all the default is occurring, it has to occur at the end of the time period. Whereas for a triple C or anything B kind of rated companies, if at all the default occurs, it has to occur much earlier. So the computation of the price for the credit value adjustment should take into account when it is going to default, earlier or later. So a very good understanding of the distribution of defaults also is very much essential, right? So these are some of the important aspects with respect to estimating the real world default probability from historical data. Now, the next aspect or target for me is come out with real world default probability, but not from the historical data. Use the equity based approach. So for that we can take the help of the Merton model. So we are trying to find the default probability from, let's say, the stock price. Right? This is a very interesting way of finding the default probability from the stock price, because if you remember the Merton model, it is directly talking about the value of the firm is considered to be stochastic. The firm value, we are treating it as a stochastic, and their default is modeled as a time point where the value of the firm is lesser than the debt that it is supposed to pay. So where the firm is unable to pay its outstanding liabilities whenever they are maturing. And in the Merton model, this D, which is the debt, it is an assumption that it's only one zero coupon bond, right? And because of that, no default can occur before the maturity date. Prior to the maturity date of the debt, no default can occur. So this is where we can very well use the option pricing formulas, and then we can do the link between the debt and the equity using the option pricing formulas, where the inputs are the value of the firm is taken as one input, the volatility of the firm is taken as another input, and the point at which the default is going to occur. And we can directly use the option pricing because there the equity is considered as a call option on the value of the assets of the firm, with a strike price being equal to the debt, that is a single zero coupon debt that has been issued for a time period T. And there we are talking about the volatility associated with the firm's assets. We are looking at it as sigma. And based on this, we can apply the option pricing formula to compute the call option, which will give me the price of the equity, the value of the equity. And so using the equity data as well as the capital structure, right, capital structure, the debt to equity information, we can very well find out the probability of default. So even if we are talking about a default, which is actually a low frequency kind of an event, I am able to model it using a high frequency stock price data. And that is what is the basic biggest advantage that is coming with the equity based approach. Of course, there are lot many limitations that are associated with the Merton model, and we know that KMV model had tried addressing some of the limitations that came out of the Merton model, and there, instead of relying on the normal distribution and all to come out with the probability of default, because if you remember in the Merton model or option pricing model, we talk about N of D1, N of D2, which are nothing but the cumulative normal distribution values associated with computations of D1 and D2. Now the KMV model is not making any such kind of assumptions, because here the Merton model has made an assumption that the value of the firm is stochastic, it follows a geometric Brownian motion, lot of assumptions have come out. Whereas the KMV model, which has used some important points from the Merton, they came out with an assessment of 1 year default probability from the historical data. So they have defined what is called as expected default probability, and based on that they have relaxed so many assumptions of the Merton model. So their process simply came out, okay, you come out with an estimation of the market value as well as the significant volatility of the assets of the firm, and from there you compute the distance to default, which is a kind of a standardized measure, right? You compute the distance to default, which is a standardized measure of the default risk. Now you make sure that you are scaling the distance to default to the actual probability of default using a historical default database. So you are looking at the different companies that have defaulted in the past. You see what was their distance to default when they have defaulted. Try to map the number of companies with the distance to default. It's like, okay, if I'm saying the distance to default is 3, okay, historically, how many companies which had a distance to default of 3 have really defaulted in the real world? So based on that, you compute the probability and say that this is the probability of default associated with the companies whose distance to default is around 3. Same way for 4. For different kinds of distance to default, from my historical default database, I am trying to obtain what is the number of firms which are belonging to that particular category have defaulted in the past. So the default distance to default is more like a standardized distance, and so here we are looking at estimating the default probability empirically based on the historical default numbers, right? How often the firms that had similar levels of distance to default have actually defaulted, and so whatever is the number that we are getting, we somehow we can try to map it with the probability of default. So this mapping of the default distance to default with the actual default probability is an empirical model that they have typically come out with. But even in this case, the EDF will keep changing. The expected default frequency is going to change because the equity prices are going to change. So the distance to default is going to change. Though the mapping of distance to default is not changing, but because the distance to default itself changes, the probability of default also is bound to change. So that is how the KMV model is helping in terms of finding out the default probability from the equity market prices. And the another approach that we look at in this context is the credit grades. Slightly simpler, similar to that of KMV, except there is a lot of simplicity and there is no proprietary thing in the mechanism. Everything is transparent. So there is no use of empirical data in the process. It's a simple formula with a few parameters. So whatever is the mechanism we are using, whether it is a Merton model or the KMV or the credit rates, they are having an importance because they are able to define the default probability dynamically, because equity prices keep changing every day. Dynamically you are seeing even the default probability also is changing. So where there is a possibility that the historical default probabilities are too static, and if I am looking at the probability directly from the credit market, it could be hugely volatile. I can very well think of. So if I am looking purely historical, it is too static. If I am going with purely market, it is too volatile. If that's the case, I can take a middle approach wherein I am following more and more of equity based models. So this is a very powerful mechanism in terms of computing your real world default probability. So these two approaches are really helpful in terms of computing the real world default probability, right? Then now we are looking at the computation of the risk neutral default probability. So we have already talked about that they are derived from the credit spread. They are not the historical data. So they are derived from the market. So generally they are derived from the credit spread. Though there is no clear definition of what is the credit spread, on what instrument we are taking the credit spread, because there are so many ways in which I can take the credit spread. So I can look at the premiums with respect to the CDSs. Whatever is the spread on them, I can take it as a proxy for credit spread. Or I can always look at the traded spreads associated with asset swap. Whatever is the spread that is inbuilt into that, that I can take as a proxy per credit spread. Or I can get from the prices of the bonds. I compare them with some benchmark. That is what we do in a very simple scenario, right? With the yield on the bond that we have issued minus the yield on the treasury. So the benchmark I can use either as a treasury or a LIBOR. So whatever is the yield to maturity or the whether it could be a Z spread or nominal spread associated with a benchmark which is a treasury or a LIBOR, or I can use some kind of mapping method. But whatever it is, there are different methods that are helping us in terms of identifying the credit spread. Now I get the credit spread, and generally this credit spread is from the market, and based on that credit spread we are trying to arrive at the risk neutral probability of default. So we know that this probability of default is majorly conditional in nature if the default occurs. So that is what, so when I am talking about the probability of default in the second year, it is nothing but the probability of surviving in the first year and then the probability of defaulting in the second year. So that is how we have to compute the chain wise. So basically if I take as an example, right, that can help us derive the formula much better. So let's say I'm dealing with a counterparty, and this particular counterparty has a 10% probability of default each year. Every year it's a constant 10% probability of default. Now all we are saying is probability of default at the end of first year, it is 10%. Now if I want to say probability of default at the end of the second year, it is as good as probability of surviving in the first year and then probability of defaulting in the second year. So this is 90% and this is 10%. So overall it is 9. So the probability, now if I take the cumulative probability of defaulting within 2 years, I look at it as 19%. Similarly, if I have to talk about probability of default in the year 3, probability of surviving for the first 2 years and then probability of default in the third year. So surviving for the first 2 years is around 81% and default in a year is 10%. So overall it is 8.1%, which means the cumulative probability of default within the 3 years is 19 plus 8.1, which is 27.1%, and the list goes like this. So the cumulative is 10, 19, 27.5, 27.1 and all. Now if I generalize it, this cumulative, if you look at it, right, 10, 19, 27, this is what is occurring, right? So this is what is the process that is coming out. And in general, if you are looking at the first one being 10, the second one being 0.9 times 10, the third one being 0.9 times 10, 0.9 squared times 10, and it's so on. Now if I add up, right, for the end of the second year, end of the third year, end of the nth year, Now this is nothing but, this is a geometric progression, right? So the geometric progression, so I can talk about sum of n terms of a geometric progression. What is the sum of n terms of a geometric progression for me? 1 minus r power n by 1 minus r. So it's as good as 1 minus r is 0.9 into 10 by 10, 0.9. 1 minus 0.9 to the power n by 1 minus 0.9, which is working out to 1 minus 0.9 to the power n divided by 0.1. So which is as good as 10 times 1 minus 0.9 to the power n. Logically, now if I am talking about h, right, now if I am talking about generalizing this particular formula for a future period u, where I am talking of h being the hazard rate. Now I can look at the same logic, right? I am talking about the first period h, the hazard rate. So if I am talking about the probability of default, here it is h, or in the next year, if I am talking about the survival, it is 1 minus h times. So in the earlier, probably let's continue with the earlier example and then we'll generalize it. So I got it as 10 into 1 minus 0.9 to the power n, right? Now this is where I can very well generalize the process also. Let's say if I'm saying that u is the time period and h is the hazard rate, I can very well assume that this is following a kind of a Poisson process. The default is following a kind of a Poisson process. So the default probability for a future period u, the cumulative default probability, I can very well say 1 minus e to the power of minus hu. So if I have to map it, right, by taking, okay, 10% is 1 minus e to the power of minus h. So based on this, I can say 1 minus e to the power of minus h is 0.9 or 90%. Right, 1 minus e to the power of minus h is 10%. So e to the power of minus h is 90%. And from here I can very well find out minus h is log 0.9 and h will come out as minus log 0.9, whatever it is. So some kind of a probability is going to work out for h, which will map your f of u to 10% for 1 year, 19% for 2 years and so on. So we again, now in general we get the h approximately. If I want to find out the hazard rate, it is nothing but I can get it equivalent to spread divided by 1 minus recovery. We don't need to get into the proof for it, but theoretically what we find is the hazard rate generally comes out as the spread divided by 1 minus recovery, where recovery I am taking it in terms of a percentage. So which means if I have to find out the cumulative probability of default within time period u, which I earlier came out as 1 minus e to the power of minus hu. So which is nothing but 1 minus e to the power of minus u times spread divided by 1 minus recovery. So this is the kind of a formula which we are arriving at for computing the default probability for a future period u. So which means if there is a lot of dependency of the recovery rate which is going to influence the default probability. So if the recovery rate is higher, 1 minus recovery is lower, spread by 1 minus recovery is higher, u times spread is higher minus u times spread is lower, e to the power of is lower, 1 minus this is higher. So, I mean, e to the power of minus is a lower. So, what we are seeing is the probability of default. If the recovery rate is higher, right? So, if the recovery rate is higher, the probability of default is also, it has to balance out. So, the probability of default also should be higher. Otherwise, there should be a difference in the pricing of the two. So, this above formula is a good approximation. Though to compute the implied probability of default, the probabilities accurately, we have to actually do a kind of numerical methods to finally arrive at computation of the probability of default. But approximately we can very well use this kind of a formula to arrive at cumulative probability of default. And once we have the cumulative probability of default, we can very well compute the marginal probability of default, because it is nothing but the difference between the two cumulative probabilities of default itself. So if I say if u1 is for one period, u2 is for one another period, subtracting both of them is what is going to come out as the marginal probability between time u1 and u2. And this is the kind of an approach that Basel is suggesting to define your credit value adjustment. You find out H first of all based on the spread, credit spread that is available in the market. You define the spread in whatever dimension you want. You use the CDS spread or bond spread or whatever, and you find out the recovery rate for different kinds of instrument. Based on that, come out with the hazard rate. And once you have the hazard rate for different time periods, you come out with the U, where different time periods you try computing your cumulative probability of default, and based on that you do the subtractions for different time periods to arrive at marginal probability of default. But of course, this is more and more of an approximation, because the H is approximately equal to this. So we can still use it because the Basel is typically going for it. But we really need to understand that this model is an approximation because it's not taking into consideration the shape of the credit curve before the time period u minus 1 or t minus 1. And a few interesting points that come out: the annual probabilities of default, they are increasing with time. Probabilities of default are increasing with time because we generally see that the credit curve is upward sloping. So the probability of default is also expected to increase with time. So the shape of the credit curve, it also plays an important part in the distribution of the risk neutral default probability. So if the credit curve is upward sloping, default is less likely in the initial years and it tends to go up, and it is more likely in the later years. But if we are talking about a credit curve which is more and more inverted, we could clearly see that the probability of default is much higher in the earlier years, but it can go down in the later years. So, or if it is more and more flat, we can see somewhere in the middle. So, even we really need to understand how the default curve is, credit curve is, so that we can do an appropriate and accurate computation of the marginal probabilities of default, which can really help us in doing the pricing of the CVA more and more appropriately. So that is something that we really need to understand with respect to risk neutral probabilities of default. And then we are coming out to some level of comparison between the risk neutral and the real world, especially how which one is higher, lower, These are purely empirical kind of results, right? What we are sometimes finding out from the results is the average credit spread which we are observing in the market across all the bonds is actually twice to that of realized losses, the actual losses that came out because of the default. So credit spreads are much higher compared to that of the default. And what we have also seen from the real world data is 1 year risk neutral probability of default is always greater than the real world probability of default, probably by around 5% or so. But as the time period is higher and higher, we are seeing that the gap is widening heavily. That's one more thing which we have observed in the real world. And the different components of the credit spread have to be understood well to really relate the actual default rates as well as the recoveries that are possible. Whatever are the credit spread, we have already said the credit spread is very heavily different from the actual default losses. Few important points in this context: the illiquidity, the reason why they are heavily different. One is the illiquidity part that is associated with the bonds. So there is a liquidity risk premium that is coming as a part of the credit spread. And there is a limiting upside holding the bond portfolio. So there is a negative skew on the returns of the bond. So there should be some kind of compensation for that. And there is a non-diversifiable, I can't create a portfolio that easily with respect to the bonds, corporate bonds. So there is a non-diversification related risk which is called as a systemic risk, because I cannot find as a security which can really diversify by risk associated with the bond. So the credit spread is higher because it is accommodating these kind of risks as well. It's just not associated with the actual losses. So that's the reason there is a difference that is clearly existing between the credit spreads as well as the actual losses, which means the risk neutral probability of default versus the real world probability of default. So as a usage, from the usage perspective, if the intention is pricing and hedging the default component, so better consider the risk neutral default probability measure. But if the intention is not to hedge the default part, you should better consider the real world mechanism itself. That should be a kind of benchmark to choose when I should use the risk neutral and when I should use the real world. So hedging the counterparty risk, I should always look at the risk neutral. And we know that the risk neutral probability of defaults are generally higher than the real world because they are incorporating various other risks as well. So it clearly comes out that these are more costly compared to not hedging, right? So those are some of the important aspects that we really need to understand when I should really use the risk neutral, when I should use the real world measure of probability, what is the advantage and disadvantage associated with each of them. And then we are looking at one more aspect in this session where we focus on the recovery rates. So we know if I have to estimate the risk neutral default probability, we have already given a formula. Risk neutral probability of default we have come out as 1 minus e to the power of minus u multiplied by spread divided by 1 minus recovery rate. So for computing the risk neutral probability of default, we also want the recovery rate. So which is the percentage of the amount that would be recovered in case the counterparty is defaulting. So it could be expressed either directly as recovery rate, or in some cases we can express it in the form of loss given default, where I take 1 minus of loss given default as a simple recovery rate and vice versa. Okay, now coming to how I get the recovery rate. Generally we get them from the market prices. The recovery rates are generally obtained from the market prices, where we try to look at what is called as a recovery swap. Right, we can have an instrument called recovery swap, wherein the swapping is occurring like a realized recovery, which is the actual recovery, versus a predetermined or prefixed kind of recovery. Right, when a fixed recovery rate is getting swapped with the realized recovery rate, and whatever is the price which is reflecting the fixed recovery is in such a way that the recovery swap has zero value at the beginning of the swap. So the swap is issued at price 0. So if the reference entity is not defaulting during the entire term of the swap is simply expiring. No cash flows are happening. But if the default is occurring, then one party is paying to the other. If the realized recovery is more than what is being predetermined at the beginning, the fixed recovery payer will compensate the other party. Whereas if the other side is higher, so whichever is higher, that particular party would be paying the other party accordingly. And so that is the very usual way of looking at the price, the recovery rates in the real world. So there is a lot of historical analysis that is getting performed. On the historical data, I'm looking at what are the typical recovery rates that are occurring. And what we also see is they vary with time. They are not that constant across. And in different industries, we see that the recovery rates could be completely different. And what we also see is the recovery rates are negatively correlated. Right, this is one important point. Recovery rates are negatively correlated with the default rates. So if the default rate is much higher, if the probability of default is much higher, the recovery percentage is much lower, and vice versa. So though they are random, the default probability and recovery rate, but because of the negative correlation that is existing between them, there is a lot of volatility that comes as a part of the default losses. So whichever is, if the probability of default is higher, parallelly there is a recovery rate that is much lower. So there is a very higher default loss that is coming up because of this reason. And another important point that needs to looked at with respect to the recovery is the timing of recovery. Again, different instruments have a different timings with respect to recovery. If you look at credit default swaps or typical bonds, I can settle them very quickly because I can sell the underlyings, get the settlement done quickly. But look at the OTC derivatives. They can't be settled in a timely manner, right? Because there cannot be a market for the OTC derivatives. There might be a possibility of the netting that may have to be done, because each bond may not be sold separately, each underlying derivative may not be wounded up separately. I may have to aggregate everything into a single claim and I have to trade as a single claim, and the value is very difficult to recover. So the timing could be a much bigger issue with respect to OTC derivatives compared to the credit default swaps. So the recovery could change accordingly. Now that is where we talk about two different kinds of recoveries. One, we bring in a settled recovery versus an actual recovery. Settled is how much should be or could be recovered by selling a bond that has defaulted. But how much is actually recovered is what is the actual recovery. Theoretically speaking, they should be similar, but in reality, they will be different because of the timing difference. It may take so much of a time for the actual settlement to occur in some kind of derivative instruments that they differ very materially. So some important points with respect to the delivery recovery that we really need to be comfortable with. So these are the different topics that I thought that I should cover as a part of this particular session. Thanks a lot for listening to the session. Thank you very much. In this session, I'm going to talk about the credit default swaps, which are one of the most popular forms of credit derivative. And what we have seen over the last one decade or probably last couple of decades is the credit derivatives market has grown by leaps and bounds. Because the major thing that was performed by the credit derivatives was it was able to transfer credit risk efficiently, and lots and lots of sophisticated products came up which were doing this job of transferring the credit risk from the risk avoider or risk hedger to a risk taker. So it is shifting the credit risk between the parties, and whatever is the value of these kind of instruments, it is purely based on the credit performance of the underlying. So I could say based on the credit performance of the a corporate, or probably it could be associated with the government or any kind of specific security. So earlier, many a times this credit default swaps used to be on a single name basis, means on one single company or one single credit, which could be of one single corporate or one single sovereign, or recently even the credit default swaps got traded on a portfolio basis also, wherein many companies underlyings were pulled together and typically created as one single instrument. So why do we really need to understand these credit derivatives? Because they create opportunities for various trading activities. They provide opportunities for hedging and mitigating the credit risk. So they are offering lot of diversification. So that's one of the prime reasons we have to understand the credit derivatives in a much more detailed manner. So as a part of that, I really wanted to introduce or do this session covering these particular aspects. I want to look at the basic elements going as a part of the credit default swap. What do I mean by credit events, and what are the different kinds of credit events that could trigger a credit default swap? Then we'll talk about how does the settlement actually occur as a part of the credit default swap. And once we know the settlement process, we can talk about what is the kind of a difference that exists between the CDS yield and the bond yield. So that is where we are talking about the basis, which is the difference between the CDS as well as the bond, which helps us in trying to understand what differences do exist. And from the perspective of the counterparty credit risk, I want to take up the contingent credit default swaps, another instrument which is exclusively targeted towards the counterparty credit risk. So these are the different topics that we'll take up as a part of this session. Understanding the importance of credit default swaps as a part of the trading market. Alright. Now, as we have already highlighted that the credit default swap, it transfers the default risk. Right? It transfers the default risk of one or more companies from one party to the other. So basically it is like if initially A has borrowed from B, right? A is the borrower, B is the lender. A has borrowed from B. So B is exposed to the credit risk. What if A does not pay? What if A defaults? So B is exposed to credit risk. Now here B is trying to take a protection from C. B is trying to take a protection from C by paying some kind of a premium to C. Now what C does, in case A defaults, C says, I'll compensate you for the amount that is defaulted by A. And that is what is a credit default swap. Now what is happening here? It is transferring the default risk. Now B, which was exposed to the credit risk, which is the default risk of this particular company, it has literally transferred it to C. Now C will have that risk. What if A defaults? I have to pay the protection part. Right? So this is how a typical credit default swap got created. And here we have two major varieties. One we call as a single name CDS, where the protection buyer, here B is called as a protection buyer, C is called as a protection seller. He is paying a premium, right? Here this premium, just like an insurance policy, it could be a single premium, which is otherwise called as upfront premium, or it could be a kind of a regular premium, which is a periodic fee to the protection seller for the notional amount of debt and for a specific reference entity. Here if A defaults, so the reference entity is the company which is going to default on its loan or bond. So if I have a single name CDS, it means I am very clearly specifying the reference entity, the notional amount of debt associated with that reference entity. So if this particular reference entity defaults, then C has to pay the protection amount to B. So if the reference entity here, which is A, either defaults or will specify some other credit events as well. Default is one major credit event. So if this particular party A undergoes a credit event, then the protection seller must compensate the protection buyer for the associated loss. So how it would be settled? It is pre-agreed. Right? What is the settlement procedure? At the time of entering into a credit default swap itself, both the parties will agree for it. And the protection buyer will keep continuing to pay the premiums until the default occurs or until the end of the period. End of the period. So if it is a 5-year CDS, up to 5 years he will pay, or until the default occurs, the period up to after the default occurs. If the default occurs, let's say in 2.5 years, and it's an annual payment, So he has to pay the premiums for 3 years. So it's a whatever is accrued up to 2.5 years, even that premium need to be paid at the end of the period. Because the premiums are paid in arrears here, not before. So here the reference entity, now when this is a CDS contract between B and C. So the reference entity, whatever we are talking of, A in this case, it is not even the party to this CDS contract. It's an external. And probably B does not even tell to talk to A to say that I am getting into a CDS contract with C. So A is nowhere involved in this CDS contract. The reference entity is not a party to the contract, and it's not necessary for the buyer or the seller, protection buyer or the protection seller, to get the permission from the reference entity to enter into a CDS. So it just need to happen that the premium need to be paid, one, either until the maturity date, let's say if it is a 5-year CDS, at least until the end of 5 years, or until the default period, whichever is the credit event period. So until that period, the premium needs to be paid. So when it comes to the premium part in CDS generally, we could see either there could be a single premium kind of stuff, which is upfront premium, or it could be a regular fixed premium every year, right? Just like an insurance policy. And if I'm taking upfront or something, or it could be a combination of both, right? And so I can keep a fixed premium of some percentage, some basis points. Probably I can say here, if the reference entity is more of investment grade kind of a bond, I may put, let's say, 100 basis points as the premium. Or if it is a non-investment grade or high yield kind of bond, let's say I can put even a 500 basis points or 5% kind of a premium. So either it could be an upfront premium or a kind of fixed premium. And one more important point is coming to the CDS documentation. So the CDS documentation here clearly specifies what is the reference obligation, means what is the loan amount, and what is the reference entity. Entity in our case, there could be a clear specification. If it is a single name, it will be clearly specified that the entity is A. It could be a corporate, sovereign, or any other entity which has issued debt, which has raised a debt. Whereas when it comes to the obligation, it clearly talks about the seniority. The seniority of the debt that can be delivered. So any debt that is having a same or better seniority can be delivered. And in some cases, no reference obligation may be specified. Then I can simply take it as senior and unsecured. So any senior unsecured, in some cases specific bond may be talked of, and in some cases it could be simply be an obligation that would be talked of, which is talking about the seniority, and any debt which is senior to that can very well be delivered by the entity. Next, we will talk about what are the credit events. Is it only the default, or are there anything more? Right? Because default is a very colloquial term that is used in terms of defining the credit event. So anything that can lead to loss, right? There could be different other kinds of events which could lead to loss to the creditors. and probably like filing for a bankruptcy. That's a credit event. It is leading to loss to the creditors. So any kind of event that could be triggered with bankruptcy, insolvency proceedings, that comes under the credit event, right? It could be talking about winding up, etc. Or we may be talking about failure to pay. It is not bankrupt still, but it is not paying the interest and principal amounts on time. So here I may even keep some kind of a minimum threshold. Okay, for last few periods it did not pay, or this much amount is pending from payment. So the threshold amount, it should be exceeded to typically call it as a credit event. Or even we can talk about failure to post a collateral. Even that could very well be treated as a part of the credit event. Probably I have given enough grace period, and even after the grace period, if the collateral could not be posted, I can still treat it as failure to pay. And then we are talking about the restructuring. The debt is getting restructured, right? And even that could result in a material adverse change in the credit worthiness of the firm. So any of these could fall under the category of credit event. And if we are talking about hedging any of our original losses with a credit default spread, now it is giving me protection against the credit risks. So the credit event will not be triggered, right? Because there is a protection that would be coming up. Credit event is not getting triggered, but there is a kind of economic loss. So the credit default swap could act in any of these credit events. Now, let's come to the CDS settlement part. What happens as a, how does the CDS get settled? We have said A and B initially got into a contract, but the B is having a worry that A could default, so that's where B has taken the protection from C by paying premium. Now, if the CDS, if the reference entity A defaults, how does the settlement actually happen? So we have already talked about the major objective of the CDS is compensate the protection buyer for the loss of whatever the par value, right? That is what will be the loss on the bond, on that defaulted bond. Now, if I look at the bond, let's say when the company reference entity A has defaulted, it's not that the bond value is zero, right? Bond value will still be something. There is some amount of recovery that is associated with that particular bond. It's not that the whole value of the bond will become zero if the borrower has defaulted. So there is some amount which could be recovered from the borrower in case of the default. Whenever there is a credit event, there could be some amount that could be recovered from the borrower. So whatever is the protection or compensation that the protection seller has to pay to the protection buyer is primarily this par value minus the recovery, because that much amount can very well be recovered from the market. So that is what we are calling as the payoff with respect to CDS. It's not the par value, because the bond has defaulted. Yeah, if it has defaulted, I should get the par value, fine. But because the bond has defaulted, it doesn't mean that the value of the bond is entirely zero. There could be some recovery. And what we are saying is the protection that is required is only for the remaining amount. And typically we talk about two types of settlements of credit default swap. It could consist of a physical settlement, or we can even talk about cash settlement. Two different forms of settlement. In the physical settlement, what happens is the protection buyer, he is giving the bond or whatever is the defaulted security of that reference entity to the protection seller. So it is like whatever is the delivered bond, the delivered bond is given to the protection seller. So here what we are saying is all the defaulted securities of the reference entity with a par value equal to the notional amount of the CDS contract. So whatever is the amount that we have entered into the CDS contract, corresponding to that, the bonds of the defaulted entity are physically given by the protection buyer to the protection seller. And the protection seller will be compensating the protection buyer with cash, which is the par value. So it is like now the bonds will not be with the protection buyer, the bonds will be handed over to the protection seller, and protection seller will compensate the buyer with the entire par value. And whatever is the recovery from the bond, the protection seller will recover it from the company. So here the whole par value is being paid by the protection seller to the protection buyer. So here it is very clearly attractive because it is between both the parties and I don't need to involve any other parties and the disputes possibility is much lesser. I am handing over the bond and so no valuations, nothing. I am giving the bond and the protection seller simply needs to compensate me with the par value of that particular bond that is defaulted. That's it, a straightforward affair. Whereas when it comes to cash settlement, here no delivery of the bond, right? Protection buyer is not giving anything to the protection seller. So the protection seller is directly getting into the compensation with the cash, which is par minus recovery. Now this is where the catch is. How do I compute the recover value? So there should be some kind of market mechanism, market based mechanism in terms of identifying what is that recovery value and then computing the cash that needs to be paid by the protection seller to the protection buyer. So this is more straightforward and this requires a proper valuation activity. So if I am looking at the physical delivery, the credit event is not specific to a given security. So if I am saying if we are talking about this, the credit event may or may not be associated with a given security. So we don't need to specify no single bond. Right? What we are simply saying is, see, let's assume a credit default event, credit event has occurred. It is not specific to one single security. So which means no specific bond needs to be delivered. So there is a choice. A simple way to talk of is there is a choice for the protection buyer as to what bond that he can deliver. What is the security that he can deliver, and because he can very well purchase it with that level of seniority or above. It's only specified to the level of, the obligation is specified as a level of seniority. So he can very well purchase the bond in the market which is cheapest, right? Cheapest to deliver kind of a bond, which could be probably a lower coupon bond or an illiquid bond, which could be available for cheap in the market, and that bond, if it is having the seniority similar to that of the reference obligation, he can very well deliver that bond to the protection seller, and the protection seller can compensate him with the cash. So this is where some level of moral hazard actually comes into picture. So today, large number of protection buyers, they actually don't hold the underlying reference entity A. So they are entering into the CDS as a naked positions. So they have simply got in because of the speculation. They just do a speculation on the CDS, and they are entering into the CDS market. There have been a lot of efforts to ban this kind of naked CDSs where you don't hold the underlying. See, because even in insurance, we have that concept that there should be an insurable risk. There should be an insurable interest in the entity that you are insuring for. So, whereas in the CDS, we are not talking of any kind of insurable interest or protectable interest on the entity. So that is where there was some amount of an effort to ban these kind of naked CDSs, but obviously if they are banned, the market becomes more and more inefficient. So it can very well happen that the CDS protection will be only against the credit exposure to hedge the counterparty risk. And now on the other side, if I look at the credit exposure, okay, today's credit exposure I am very clear of. But what about the future? What about the future credit exposure if I am talking about a derivative transaction? That is completely uncertain. So I cannot decide how much of CDS protection I require for hedging purpose for my credit exposure that might crop up in the future. So it could be more, I could buy more protection than my exposure so that I don't increase my exposure in the future. So the problem, right, the important problem that is coming up here, one, in CDS market, if I am getting into a naked position, I've already understood that if the naked positions don't exist, the CDS market becomes more and more inefficient. And especially with the derivatives market, I could see that the potential future exposure is much higher compared to the current exposure. So which means I need to have some kind of compensation or a protection against the future exposure that is going to crop up. So how much CDS I have to buy might be a difficult stuff, which means I end up buying more CDS protection than the current exposure to mitigate a potential increase. And probably look at the other dimension of the CDS market, or probably another problem with the CDS market. We can also talk about the delivery squeeze. The amount of notional that is required to be delivered is much greater compared to the amount of outstanding debt. Right? The amount of notional that I have to deliver could be much higher compared to that of the outstanding debt. Now this is what we are referencing as a delivery squeeze. So what could happen in this case? I am delivering a notional which is much higher compared to the outstanding debt. The prices, the bond price is going to increase, and the bond price increasing because there is a lack of supply of that particular bond. I have to deliver much higher. So there is a lack of supply that is existing, which will push up the bond price. And once the bond price is going up, the value of the CDS is going to fall even more further. So it could create a significant discrepancy between the recovery value of the security and whatever is the recovery that we are defining as part of the CDS contract. That could be another big problem which is falling under the category of delivery squeeze that could very well exist with respect to the CDS market. So these two aspects we have to clearly understand with respect to the settlements in the CDS market. Now, what is this difference between the CDS and the bond? The credit default swaps and the bond. See, you can very well see if I virtually try to recreate the CDS protection, I could clearly look at it like a protection in a fixed rate bond, right? If I am looking at a CDS virtually credit default swap, I have taken a position in a fixed rate bond and a payer interest rate swap. So I am paying and I have taken a position in the fixed rate bond. So under some assumptions, I can very well virtually try to create this kind of a position. So the combination of a bond and fixed rate bond, the combination of a bond and an interest rate swap, this combo is nothing but it's an asset swap. So simply speaking, if we are talking about the spreads from the CDS and the bond markets should be similar. But in reality, there could be a lot of differences between the two because of various technical and fundamental factors. And that difference between the CDS and the bond spreads. Spread is nothing but the premium over the risk-free rate. So logically speaking, these two should be similar, but because of various aspects, they differ. And that difference is what we are calling as CDS bond basis. So positive means CDS spread is higher compared to the bond spread. Negative means CDS spread is lower compared to an equivalent bond spread. Now what we are trying to understand is what are the factors that are going to drive this spread. One, look at the counterparty risk. So in CDS, there is a very significant problem with respect to wrong way risk. What is this wrong way risk? Okay, let's go with our example itself. A has borrowed from B and B has taken a protection from C against the default of A. Now, what is the intention there? If A defaults, C has to compensate B. But when A defaults, what if C also defaults? What if C also defaults? Which means, what is the probability of joint default of A and C? What is the possibility of a joint default of the protection seller and the original defaulting original borrower? So that kind of a correlation that is existing between the two is what is giving rise to this wrong way risk. And in the credit default swaps, this risk is a very significant risk, which means the spread is the basis is becoming more and more negative there. Because of counterparty risk, the basis is becoming more negative there because the CDS spread is falling with respect to the bond spread. Similarly, now let's look at another aspect, which is funding. The intention everywhere is the CDS is supposing that LIBOR funding is possible. But if funding happens above LIBOR, which means the spread becomes much higher for CDS, so obviously the basis will be positive. But if the funding was possible less than LIBOR, below LIBOR, then probably the basis is becoming negative. But this is a very difficult aspect. If the funding happens at an amount which is above LIBOR, at a right rate which is above LIBOR, then the basis is going to be positive for the bonds, because CDS actually requires no funding. Now this is where CDS requires no funding, whereas with respect to the bonds, we are talking about the funding which is above the LIBOR or below the LIBOR. If the funding is above the LIBOR, the bond yield is going lesser, bond spread is decreasing, means the CDS minus the bond is becoming more positive, and vice versa. So the funding could be one more aspect that could have an influence on the basis associated with CDS and bond. Then how do I define the credit event? The definition of the credit event could be one more. Right? In some cases it might very well happen that the CDS credit events coincide with the credit losses for the bondholders, or in some cases it may very well happen that the CDS protection seller is going to pay out on an event that is not considered as a default by the bondholders. So it may be a payment from the CDS protection seller, but it may not be a kind of a loss that is incurred for the bondholders. Or it could be happen the other way also. The credit event may not be triggered for the CDS, but the bondholders are taking losses. So it can very well happen. So in the first case, it might very well happen that the basis is going to be positive, whereas in the second case, the basis is going to be negative. So even the way we are defining the credit events talk about the basis to be positive or negative. Then we already talked about the cheapest to deliver kind of option. So the CDS protection buyer will have an option of the delivery, will have the option of the bond that can be delivered. So that is making an possibility that he can buy the cheapest available bond and he can deliver, which is actually making the basis to be more and more positive. And we have already talked about the delivery squeeze, right? Shortage of CDS deliverable debt, and that is making the basis to be negative. There could be the bonds in the market which are trading above or below the par. When the interest rate is changing, depending on how the interest rate has changed, some bonds could be trading above par, some of them could be trading below par. Whereas the CDS protection is always indexed to the par value. So which means if it is above, if the bond is trading above par, obviously I could see that the basis is negative. If it is trading below par, I could see that the basis will be positive. So all these factors are probably, if I am looking at accrued interest. In the event of default, bond does not pay accrued interest for any coupon that it has owed. Whereas when it comes to CDS, the protection buyer has to pay the accrued premium up to the credit event. So again, it is making the basis to be negative. So some of the definitions and some of the concepts associated with the CDS and the bond, they are driving the differences between the spreads associated with the CDS and the bond. And that is what we are trying to call it as the basis. And the basis could differ, and we have to have a very good understanding on the basis. And one more aspect that I would like to bring here is, how do I see, till now we have been talking about the credit default swap associated with a loan or a bond. But how do I associate it with an exposure, with a credit exposure in a derivative contract? Right, in a regular CDS, till now whatever we have seen, the protection buyer has the protection on a fixed amount. The par value of the bond is already known. So for loans and bonds, that aspect is very much fine. But when we look at the counterparty risk, the loss that is determined at the time of the credit event is very much unknown. That is what is the counterparty risk. The loss that is getting determined at the time of the credit event is unknown. And that is where this instrument contingent credit default swaps came into picture. Everything works like a single name CDS, but the major difference is the notional amount. We are not linking it to the par value of the bond. The notional amount of this CDS, it is referencing to another transaction, not, so it is referencing to the value of the transaction. So it could be any product across any asset class. So that is where we are bringing in the derivatives transaction, the value of a particular derivatives transaction, where I am linking it to the exposure of that particular derivative contract. That is what makes the contingent credit default swap product different from the regular CDS. So it is becoming more and more tailor-made to hedge the counterparty risk. Right? It is transferring the counterparty risk from one institution to the other. But still they did not get that much of popularity as the straightforward CDSs. One, there was a lot of complexity that is associated with the documentation. Right, because it has to reference the transaction for which the counterparty has to be transferred. So there is a lot of complexity that is associated with the process. So it is not taking into account the netting and the collateral because it's against one single transaction. So it does not take into account a netting set. It is only talking about one single trade. So netting sets are not getting considered. And so all the trades that are a part of that netting set, if they have to be considered, then the complexity is increasing. And to how much extent the collateral is reducing the risk, even that portion is not taken into consideration. That's one more drawback. And there could be a possibility of double default. Right, because the CCDS provider, that particular entity needs to have very high quality, and they really need to be very much uncorrelated with the original counterparty, otherwise wrong way risk. So if the wrong way risk is higher, then probably the whole concept of CCDS will go waste, and it's very hard to have that kind of a provider who is having a high quality and who is nowhere correlated with the original counterparty. So that's where there could be they are not popular, and which means there are the sellers of protection, they are not many in number. Right, very less in number. So which means the product is not becoming popular because of that. So a good understanding of credit default swaps, their operations, how they are playing a role in the counterparty risk is very much essential for us to understand. So thanks a lot for listening to this session. Thank you very much. In this session, we'll talk about curve mapping. Just before defining or getting into this curve mapping, let's recollect what we have done for computing the risk neutral default probability. we had a formula, right, for computing risk neutral default probability. We have got it as the cumulative default probability is 1 minus e to the power of minus u times the spread divided by 1 minus recovery. Remember this formula? Recovery rate. Now, we have simply specified that the default is driven by a Poisson process and the default probability for a future period u goes like this, and wherever this amount was there, this number, this is what we have called as the hazard rate. Hazard rate approximately is equivalent to spread divided by 1 minus recovery rate. Right? Now, this is the most important aspect for us for this particular session. We have very clearly linked the risk neutral default probability to the credit spread associated with that particular counterparty. Now, we have also talked of that the credit spread can be obtained either from the market prices of the bonds of that particular party that are traded in the market. I could get them from the single name CDSs, again where the reference entity is that particular bond that is that has issued a debt, CDS, CDS that has been traded, where the reference entity is that particular company. So I could use any of these mechanisms to come out with deriving the spread. And once I know the spread, I can find the probability of default, and probably this probability of default will help me in going ahead to the computation of the credit value adjustment, which is going as a part of the pricing of the counterparty risk. But what can I do to get the credit spread? How do I get the credit spread if that particular counterparty, there is neither the bond that is trading in the market nor the CDS that is trading in the market? So no defined credit spread that is trading in the market. How do I get the spread for those kind of parties? Now that is where either I may have to go with some kind of subjective mapping, right? So which is more and more non-scientific in nature, but it's important process for me or for any kind of a bank to value the illiquid assets that they carry, which are not traded in the market, like the loans which are held on their trading books, which are not traded. Especially when I look at the Basel III norms, so they impose the risk neutral way of calculating or coming out with the capital allocation for the CVA. A risk neutral methodology has to be adopted, which means if the credit spread for that particular instrument is not available, there should be a mechanism where I can use an appropriate proxy, which could be based on choosing a company which is having a similar rating as this particular counterparty, or probably if possible from the same industry or from the same geographic region. So these kind of things should be there, and that is what is the major intention of the mapping. We are trying to map the credit spread of some comparable counterparty to the spread of that particular party whose spread is not explicitly traded in the market. Right? That's the major intention behind the mapping process. So we'll try to understand some basic aspects of mapping and how do I really look at the indices and the different classification associated with the mapping, and how does a curve shape play an important role in the mapping process. Okay, so we all got a clarity. Why do we do mapping? So we are trying to see, or we are trying to explore some important points to get some kind of a general curve based on the market data. I use the market data, based on that market data, come out with some kind of a curve which I can very well use for those counterparties whose spread is not traded in the market. So I'll have some kind of a curve where I'll take maturity on the x-axis and I'll take probably the credit spread, whatever is the definition. It could be a CDS spread or a bond spread or whatever. Credit spread I'll take here, and for those firms or for those parties whose numbers are available because of the market data, we'll try to plot them and we try to come out with some kind of a smooth curve like this. So where we are taking a number of points at different maturities and we are trying to come out with a best fitting line. Right? It could be a best fitting curve which would be passing through a good number of points. Now here, this kind of a curve I can have either on a broad basis or very much granular. When I say broad versus granular, I'm taking the whole industry, or I'm taking all kinds of bonds in one single category itself, like all A-rated bonds. So different maturities, different spreads. So there could be more number of points for me because we are going with different, large number of companies which are having A rating. So large number of points. So it is very much possible that we get different kinds of, we may not get all the points aligned on the line, but we cannot distinguish between the different counterparties. I can't say that this is from the banking industry and this is from the IT industry. There is no way I can differentiate industry wise, geography wise, etc. But if I come to granular, I try to plot this kind of a curve specific for each rating, okay, A rating. And within that A rating, I may look at the sector, okay, all pharmaceutical companies, all companies in the IT industry. Or I can look at geography wise, Indian companies versus companies in the United States. So I can have for each, right, I can talk about, utility sector of India which is A rated. So I can very well have different kinds of curves for different, which means the number of points are much lesser, but I can very well distinguish between the different counterparties. Right? So there are advantages and disadvantages of each of the aspects. So that is what we are doing as a part of the mapping. So initially from the data that is observed from the market, we are plotting some such kind of a curve. And after that, any company for which the spread is not publicly traded, I try to map that to any of this point on the curve. Then the next aspect is, how do I really look forward for the indices and the classification aspects? Now on one side we have already talked about the bond spread. They are helping us in coming out with some kind of a mapping. We have plotted a spread curve So they help us in going with the mapping. Now, I really need to, the main process as a part of this mapping is how do I link it to the hedging of the credit value adjustment. So for mapping the credit curves, we really look forward towards the credit indices itself. So they are the better choice for mapping the credit curves. So I can very well map to a single choice or single name CDS or any such kind of a proxy. And if such information was not available, I can map it to a relevant index as well. So depending on whether it's a corporation or a sovereign or any, and I can even go into subdivision and the credit quality. So the indices and the classification indices can really help me in doing such a kind of classification quite comfortably. So I can do the classifications like, okay, at a CDS level, I can very well look at the CDS. What is the proxy, right? Is it the index that is the proxy, or can I look at single name CDS proxy, or it could be, if it is directly traded, I could look at single name itself. So here we are having the mapping can be done like this. Either I map it directly to the single name, which means it is traded. I can have the proxy of the single name, or I can have the proxy of the entire index. And here I could see the different kinds of counterparties, whether they are corporate or sovereign or any other financial institutions. What is the kind of ratings they carry? Are they investment grade or speculation grade kind of ratings? And what is the kind of index that I need to map? So probably I can look at iTrax Europe index or iTrax Europe financials. Any of these indexes I can look at and I can think of the mapping. And okay, here comes another important aspect in doing the mapping, which is the shape of the curve. So let's say in many cases, it could very well happen I can only define the credit spread for a single maturity, right? I can only define, let's say, for 5 years. Whereas for other years, I may not be able to define the credit spread because I don't have the appropriate instrument trading in the market. So for the rest of the curve, I may not be in a position to define the credit spread. In that case, what we are saying is, now look at an index curve. If I know, okay, this is the index curve, right? Let's assume that this is the shape of the index curve for different maturities and the spread. Let me assume that this is the index curve. Now at 5 years maturity, let's say this is the index, and for my particular instrument for 5 years, let's say this was the spread. Now what we are saying is follow it along the index curve. Follow it along the index curve. So use the most appropriate index to define the curve shape and just map all other points with respect to the index curve. So you can use the shape of the index curve, which is more and more appropriately suited to the region, to the industry, etc., and use that curve as a base to plot the entire mapping curve for this particular security as well. So this is one more important aspect as a part of the curve mapping. So just try to understand that curve mapping is a very simple concept, though it is very difficult to implement, especially for those parties where spread is not explicitly traded. Spread cannot be derived through the explicit trades that are happening in the market. We need to have some kind of a mapping procedure, and now that is what we have looked at as a part of this small session. Thanks a lot for listening to this session. Thank you very much. In this session, we are going to look at the portfolio credit derivatives. So, two major categories, one being the index tranches, which is breaking up the index, and the second one is the very highly popular CDOs, collateralized debt obligations. Right? Collateralized debt obligations. Another world of portfolio credit derivatives. So we are first focusing on the index products associated with CDS, and then based on that we'll create an index tranche, and after that we will be looking at the collateralized debt obligation. Right? So just to get started with the CDS index products. To probably until a decade back, whatever are the credit default swaps which were existing in the market, they were more and more single name, which means there is a very clear cut reference entity on whose default the protection seller will be paying to the protection buyer. But after, or probably in the last one decade, because of the market liquidity and the growth of the credit derivatives market, we started seeing the credit default swaps on the indices as well. So whenever we are using the word credit index, a few important things: it is equally weighted, it's not based on market capitalization in very regular scenario, it's an equally weighted index, and it's a combination of a good number of single name CDS. Right? In general, our most popular ones are having 125 different single name CDS. So because they are equally weighted, the fair premium on the index will be more and more closer to the average CDS premium, because they are all equally weighted. And looking at the common ones, we have iTrax Europe as one very popular CDS index, and we also have CDX NAIG. Okay, this is more associated with Europe. 125 companies or 125 single name CDSs. So which means 125 investment grade reference entities. Right? They are all investment grade reference entities and there is an equal weightage. Similarly here, NA is North America, IG is investment grade. So we are talking about again here also 125 investment grade corporate entities equally weighted. Of course, there are many other such kind of indices, but these two are very popular, one from Europe, one from US. So if I am saying I am buying a CDS protection, right? Let's say I am talking about I have bought a CDS protection for 125 million on CDX NAIG. It's as good as saying I have bought a protection of 1 million each on each of the 125 companies which are registered as a part of the CDS index. So each of the 125 companies I have bought protection for 1 million each. It's same as I have bought 125 million protection on the index. Now the good thing about this index is there is a roll every 6 months. So the constituents of the index keep changing. And the major factors that get considered are there is an adjustment to the maturity that happens during the rolling process. So the the maturities, again, these indexes are available for different maturities, typically 5, 7, 10 years. So according to the maturities, the constituents are adjusted. Similarly, the portfolio gets adjusted because when we are talking of including a particular name or removing a particular name, there is a very clear-cut criteria that is defined with respect to the credit events, with respect to the ratings, with respect to if at all the ratings are downgraded or increased. So based on all these things, the entry and exit of a particular name will be done into that 125. So to a large extent, the intention is to maintain a homogeneity with respect to the credit quality. So any kind of deviation of one single company from the group, either increasing the credit quality or a fall in the credit quality, will be removed from the index and some other company would be added into the index. Then the other factor that gets considered is the premium. The index premium is actually fixed before the rolling. So it would be fixed depending on investment grade, let's say 100 basis points, or if it is a high yield or a speculation grade, let's say it would be fixed at 500 basis points. And the trades on the index are typically involving an upfront premium payment from one party to the other, and the intention is to compensate for the differences between the fair premium and the traded premium. So that is what is constituted by the upfront payment. So that's the importance of the CDS index. Now this is the whole index on all the 125 companies, inclusive all 125 companies included here. Now if I do a further breakdown, right, this 125, if I do some kind of prioritization while I am issuing the securities on the top of this tranche, that is where we are calling as index tranching. So when we talked about the simple credit index, we are looking at all the losses on the underlying names, whereas when we bring the word tranche, we are looking at only some percentage of those losses. So I could very well specify generally X%, Y% for each tranche, which means the losses that are lying between X% and Y% on the underlying index would be absorbed by this tranche. So the tranche could be created like this. Okay, I'll create a structure, let's say, for the tranche, right? Both of them. Let's say we are talking of iTrax Europe, or we talk about CDS NAIG. Whatever are them, there is a tranching that is happening. Okay, this is like 0 to 3% tranche. or probably I may say this is 3 to 6% tranche, 6 to 9% tranche, 9 to 12% tranche, 12 to 22% tranche, and probably 22 to 100% tranche. Same way here, there could be another kind of a classification which CDS NAIG might have done, 0 to 3%. They do it as 3 to 7%, 7 to 10, then they have 10 to 15 tranche, 15 to 30 tranche, and 30 to 100. What does this mean? So if I talk about this particular tranche, this will absorb the losses only if the overall losses are between 15% and 30%. Right? The losses that are lying between 15% and 30% on the index will be belonging to this tranche. If the index has lost only 10% or 9%, then only these three tranches will absorb the loss. These are completely safe if the index has lost only 9%. That means there is a kind of subordination structure that is coming out when we are bringing in the tranching. So the subordination of that tranche is X%, whereas the detachment point, so anything above it does not belong to it. So the detachment point, I can look at it as Y%. And probably Y minus X is purely talking about the size of the tranche. So this naming wise, this is typically called as equity tranche, which is the one that is absorbing most of the losses in the beginning. And probably someone's in the middle are typically called as mezzanine tranches, and towards the top we are calling them as the senior, and there could be a possibility of even a super senior kind of tranches. Super senior tranches are much more safe compared to senior, then the mezzanine, then the equity. Equity tranches, they are the ones that are going to absorb the losses first. So this 0 to 3 typically I can call them as equity tranche, and as I keep moving up, the topmost could be a senior or a super senior tranche, and someone's in the middle are typically called as the mezzanine tranches. And if you look at the way the losses are absorbed, each tranche is covering only a certain range of losses. So the risk levels are completely different. Equity tranche is absorbing large amount of risk. So which means the returns that they need to receive could be much higher. The expected returns that they need to receive could be much higher. Whereas the senior tranche, the risk chances are much lesser, which means the return should be more and more moderate. So that adjustment has to come for different kinds of tranches. Super seniors could be almost no risky, which means their return should be even more lesser. So the whole tranching is creating a kind of a leverage effect. So the junior tranches are carrying more and more risk, whereas the seniors are carrying much lesser risk. Right? But on the other side, from the counterparty risk dimension, if I am looking at, the more is the senior tranche or super senior tranche, right? They are considered safe, which means the provider has to provide them a return at any cost. So the higher is the super senior tranche, I could very clearly see that the counterparty risk is going to be much higher, because the inability to pay will create a bigger impact on the provider, which is very much pushing up the counterparty risk. So if I really have to look at the number of defaults. So this is where a calculation is coming. Number of defaults a given tranche can withstand. Right? What could be the minimum number of defaults or maximum number of defaults a given tranche can really withstand? I can very well talk about it as n times x divided by 1 minus recovery rate. What do I mean by this? N is the number of names that are there in the index. So typically 125 in the two major indexes which we talked about. There are 125 names in the index. So 125 companies included. And X I am talking about as the attachment point, which is the beginning percentage for that particular tranche, the beginning, and this is the recovery rate. Am I getting 40%, 30%, whatever it is? So let's look at. So if I am talking about let's say an iTrax, right? iTrax Europe CDS. Let's say I talk about a recovery rate of 40%. So what is how much can a super senior tranche withstand? And let me define the super senior tranche is, let's say, anything between 22 to 100%. So in that case, the maximum number of defaults that this tranche can withstand, okay, n is 125, x the attachment point, the starting point of that particular tranche, 22%, divided by 1 minus the recovery rate. So 40% is the recovery, so I'll do 1 minus 40%. So whichever comes, that would be the minimum number of default that this particular tranche can withstand, and beyond that there could be a loss that could result for this particular tranche. So that's how we can compute what is the kind of withstanding any particular tranche can do before it starts taking up the losses. Now, so then moving on to the next important portfolio derivative, which we called as collateralized debt obligation, which is a CDO. Again, there are different types of CDOs in different contexts. So I can create them on different kinds of asset classes which we know. And they could have different structural features. But generally, again on a broader scale, we have a senior tranche, we have a mezzanine tranche, and we have an equity tranche. Again, may or may not be a super senior tranche. In general, I look at CDO. Whenever we are talking of CDO, we are talking of two different broad categories. One, I can look at them as synthetic CDOs, the other structured finance CDOs or structured finance securities. So the synthetic ones, generally we call them as collateralized synthetic obligations. So they are very similar to index tranches. So except that the attachment and the detachment points could differ. Maturity could differ. It could be tailor-made. And they can be very much tailor-made to any particular transactions. So a tranche, another important aspect is a tranche could be traded in isolation from the rest of the capital structure. I can trade the tranche separately in isolation. And typically we see that the banks have a good large number of correlation desks which are typically involved in trading many different tranches of the synthetic CDOs on different kinds of portfolio. So that's where they differ from the traditional index tranche. But when I come to the structured financing securities, so here there could be different kinds of securitization structures. So there could be some cash CDOs, there could be collateralized loan obligations, there could be mortgage-backed securities, and there could be different kinds of CDOs based on the asset-backed securities. So there could be different such kind of structures. So the major difference between these structures and the traditional synthetic is the structure of them and the tranche losses that could occur by a very complex mechanism here. So the tranches of these deals, they cannot be traded in isolation. They cannot be traded in isolation, and all the tranches must be more or less sold simultaneously. So that is the reason we call it as a full capital structure transaction here, whereas in the synthetic CDOs I can very well go with trading each of them separately, each tranche separately, and it could be completely different from the rest of the capital structure. So just to get an overview, right, we should understand the default probability, we should understand the credit spread, we should typically know how do I differentiate between the different portfolio credit derivatives, right, and once we know it, probably we can go more and more deeper in terms of even finding out the values of it. Here the intention is just to get a basic feel and flavor relating to the portfolio credit risk. Thanks a lot for listening to this session. Thank you very much.